everybody's doing well. Good morning. Just waiting for my confirmation that audio is going through. All right, so it's important you pay attention to this risk disclaimer. All right, so we are looking at the E-mini S&P futures contract for March delivery 2023. And in the upper left-hand corner, this one up here, that's the hourly chart. And the lower left is the 15-minute time frame. And the larger chart to the right is the 1-minute chart. All the same market, just different time frames. All right, so if you're not following me on Twitter, you're probably not going to appreciate as much as those individuals that watched me outline this morning. It was really short, but I'll give you the context as to why I was drawing everyone's attention to the buy side liquidity and what we may or may not see going forward for the rest of the day. So the topic I want to talk about is conquering fear of being wrong versus the focus being on profitability. So if you're starting with me or in trading in general, it's easy to get inundated with the fear. And I promise it won't be a long, drawn out, boring session because I'm going to take you into the charts. But I kind of like want to build a foundation here as to why I'm going to be talking about this topic and why it's something that it's important for you to tackle early on. But it's also something for you to minimize as a concern. In the beginning, when you first start learning how to trade and you're watching these charts and it looks like a foreign language you've never learned before, pressuring yourself to try to find correct entries, correct stop placements, targets, which time frame, which market should you be following, what approach or model or technique are you going to employ. Those are all normal things for a new student or trader to be concerned about. But the most significant factor in a developing student's mindset is conquering the fear of being right or wrong. And more specifically, the fear of getting it wrong. There's nothing wrong with doing it incorrectly, but there is a lot of things wrong with doing it incorrectly, recklessly, with over leveraging, over trading, and just gambling. So there's a lot of things that I teach in price action that are repetitive in nature. They tend to repeat when conditions are prone to produce the outcome that we're looking for. Now, there are times when even myself, I'll go in and I'll expect a certain price delivery, something to bring in a certain response in price action. And I try to align myself with that mindset through the charts, through my teachings. So that way my students that are following me on Twitter are alerted to where I'm thinking the market's going to go to next. Now, don't do it yet because the tweets are already there. I can't change them. I can't edit them. Okay. And you can see the responses from people that were watching it then as well. I don't delete any tweet. Sometimes I'll do a typo. I may or may not catch it, but whatever tweet I put out, it stays. So you can grade my consistency based on all of that, as well as the precision. So when we're looking at being correct or trying to avoid being incorrect, what we're placing on ourselves is an unrealistic expectation because nobody is perfect. I'm not perfect. I do get it wrong. Sometimes I miss trade. Sometimes I enter a trade and it will hit my stop loss and I never get a profit out of it at all. And there's nothing wrong with that. It doesn't mean that the model that I employ or the concepts that I use and create, they fail in my use because I'm the operator, not the concepts themselves. I've misinterpreted price. So there's a great deal of responsibility that is placed on me as the analyst slash trader while I'm trying to keep the gambler that's in all of us at bay, trying to preserve equity and keeping the hands of the gambler out of the equation. So when we look at charts, and what I'm lending you in my experience is by being on Twitter, I point to levels that I think are the next draw on liquidity. I think that providing that tool, that resource, allows my students to at least engage. And this is my opinion now. Okay, it doesn't mean I'm correct, but my opinion and my thought process is if I've been doing this for 30 years, I think it's reasonable to assume that I would have a better understanding where price is going to go than that of a new student or a new startup or someone that's casually just viewing my tweets or my content. Can I show before the fact where the market's likely to go to next and what narrative behind that exists? So if we're looking for repetitive patterns or delivery and price that should be consistent, doesn't mean it's going to be 100%. It just means that over a long sample size. What's a long sample size? Well, it's relative to whatever you think is reasonable. Yeah, I think reasonable is a year. 1 year of consistently being able to see the market real time, call it beforehand, tape reading, practicing. Then I think, in my opinion, and you may want to disagree with this, but after a full calendar year where you see all of the seasonal factors that come into the marketplace, all the seasonal tendencies, the geopolitical tug of war things that create, well, reverberations through the marketplace because those shock waves will be seen in these candlesticks. So having a full year behind you allows you to have the confidence that you've seen enough to know that this is worth pursuing. While I'm talking about this, I'm watching the 4032 level. There's buy side up there. So as I'm talking to you, I'm just thinking out loud. It doesn't mean I'm taking a trade. I'm already done for today, and I'll show you why I did what I did, and we'll go over that. But I want you to think about how learning from a book, okay, learning from a course, learning from static texts that come in a PDF format, okay, they all have their place in our learning. They all have a certain measure of value. But seeing something demonstrated repeatedly over and over again, week after week, day after day, taking your focus into a specific location and price action, and then watching that price deliver real time from an alert that comes through a tweet that says, note this on your chart. This morning I noted in a tweet, I said 4028, note that level, that's your buy side liquidity. The reason why I sent that tweet out was I was watching price in here. See how it's relatively equal here? Now, retail traders, and I apologize, you're going to hear one of my boxers, Bella, she's barking. She's trying to get my attention because she knows I'm upstairs in the office. This area here, it looks like resistance to retail traders. So whenever the market looks smooth like this, I have an expression I like to use all the time. Smooth edges like to be made jagged in the marketplace. Much in the same vein, you see these relative equal lows. The market goes through them multiple times and then reacts. This level in response to this shaded area, I'll cover that also because I mentioned that in a tweet before the fact too. But I want you to think about how the things I'm showing in my tweets and in my recordings and my executions, because you're seeing one right here, it's based on things that repeat over and over again algorithmically in price. So when I'm looking at price and when I'm trying to teach you as my students, I'm not trying to put your mind into the framework of looking for patterns for pattern's sake, which is equivalent to what indicator traders do. And allow me the liberty to say that without feeling like I'm beating anybody over the head, because I know there's traders out there that use indicators and they're profitable. But I want you to just take a step back and think for a moment. If you're using, by contrast, I want you to think about what I'm teaching them and what other traders do with indicators. If you look at an indicator and you're measuring the bullishness or bearishness of a particular market on a specific time frame using any indicator, it could be stochastic, it could be RSI, CCI, MACD, you name it, whatever it is, you're attributing a religious belief that that indicator and its compression and manipulation of data, which is the open, high, low, and close that's already happened. That's all these indicators do. They number crunch. They take something that's already happened, which is what you've already seen here in this chart. These candles are representative of the raw data that the indicators use to compress and crunch and spit out some kind of overbought, oversold, or continuation or something to that effect. And when I first started as a trader, it was important for me to figure out what indicator I should be using. And over time, I learned that it's not all that important because I got caught up in, I just want to take a quick look at NASDAQ. The indicators are not the secret. Not when I first started, I felt that it was. And I had a lot of indicators on my chart, lots of them. And it became a pursuit of finding the pattern in indicators. So one can argue, and this is my argument here, that if you're looking at indicators, you're no different than someone that looks at just a classic chart pattern. You're looking for the pattern of price delivering on the heels of something you've attributed to with a religious belief. And there's a lot of atheists in this marketplace that are still religious because they have their faith based on something that may or may not be the real catalyst for why price is going where it's going. And that to me was a big shock when I discovered that my faith that was in indicators and the use of them wasn't needed. At least for me, it wasn't needed. And it provided clarity when I removed them from the chart. And I take a step back all the time and I try to think about how I'm going to present this in a way where I won't offend someone, because invariably I'm going to offend a group of listeners or viewers. It's not my intent. Okay, my intent is for you to just think about it for a moment and think about how this may or may not be true for you. But when I took away the indicators, it was scary for me because I felt like I was blind. Like I didn't know what I was doing. I was trying to drive in the dark with no light. That's scary, right? So what it took for me to grow in trading naked with nothing on the chart, no indicators whatsoever, I had to understand why I'm even anticipating a specific price move in the first place. So I'm looking for reasons why the market should go higher. Okay, why should it go higher? Well, the market has gone to a specific level. It's shown a willingness to go higher. It's punished those individuals that have already tried to go long. And there's a area where traders that would be profitable as the market dropped, where would they have their stop loss? And I started thinking about the market from a cannibalistic stance. How can I devour the less informed traders? That was the mindset. So instead of going in and looking at price action with indicators over the chart, I started thinking about where are all the traders out there right now in the marketplace, where would they have an order resting, whether to get in the market or get out? where would they have a protective stop loss? And the logic that most retail books would promote is this is resistance. So therefore, as the market drops, where would be the easiest place to place a protective buy stop, protecting that short position? It would be above these highs. That's exactly what every person that does any kind of retail level trading, when you first get into the marketplace, that's the first lesson they learn. That's the first sip of the Kool-Aid that poisons your entire outlook on price. I did the same thing. I'm guilty of that too. It's hard to believe that they would allow all these books out there with all this misinformation, but yet they do. Misinformation, in the hands of someone that's reckless, can cause blown accounts. I've done that. Depression, I've experienced that. Repeated failure, I've experienced that as well. That changed when I stopped forcing my treasured authors and mentors who I had foolishly placed faith in because they shown me static examples that they didn't actually trade themselves. So there's a limitation in terms of what you can learn from someone, even me. If I would have never started doing what I'm doing here, or when I was doing mentorship and showing my students daily, like you're getting the experience of right now on Twitter, stop asking me to join because I'm doing it for free, right in front of everybody. Everybody's here listening. Everybody's able to watch my tweets, okay? That's the mentorship. You're all part of it when you go there. It didn't cost you anything but the time invested. But it's going to take you time to divulge, or for me to divulge everything that is that I want to cover. And I think a minimum reasonable expectation in terms of time is a full calendar year because there's seasonal tendencies to come in the marketplace. But you're going to see a reoccurring theme that repeats itself, that I'm taking your attention to the most important level next. Contrast that with, all right, we're going to do a market review, and here's the trade I did. I think I got in here, and I poked fun at people that's on YouTube like that. If you've taken a trade, you'll show that you've taken a trade. Why wouldn't you? Why wouldn't you do that? So it's an unfortunate thing that we as new students, new traders in development, and I was like that, 1992, we place a great deal of faith on logic that we've not proven ourselves, and we've not seen the teacher themselves prove that they understand it as well. So one of the things I set out to do as a trader is figure out why the market should go where it's going to go next. There's lots of things that you can use, even from a retail trader's perspective, to get into a trade. Getting into a trade is easy. Understanding why you're getting into that trade is more significant and more important. I'm just checking down real quick. Also proving that your video isn't frozen. So knowing why the market should go where it's going to go next with a great deal of probability, statistics behind the faith that you hold in that price movement panning out on your chart. What's the logic behind that? Days, weeks, months of back testing, forward testing, and tape reading. You can't become precise with your trading without doing that. No trader, no mentor, no teacher, no course, no program, no black box thing that you can follow that gives you signals. None of that is going to bridge the gap between you trusting in the core being of who you are, the thing that you're doing, and risking potentially, if you ever decide to do this with real money. You have to have the faith that no person, no other teacher, other influence can remove your faith in what you're doing because you've done it, you've handled it. So when I set out to figure out what it is I'm looking for in price action, I wanted to target and victimize the less informed traders because I was tired of being one of them. And I took that anger and that resentment I had all the time, the money I invested in things that weren't able to be profitable for me. Blown accounts, failed continuously. I couldn't find traction. So I was looking for a way to take away all of those things that I discovered were the very vices that caused me to put this unrealistic expectation on myself that I had to be right. I had to be right about the direction, yes, but I had to be right about the market too, which one was I going to trade, because I was a commodity trader when I first started. And what time frame would I trade on? I had to be right about all those things, folks, just like you are. You're holding yourself to the flame. And if you don't know what you're doing, you'll get too close to the flame and it burns you. So I have to take away all the distractions in my perception about price and focus on where's the pain going to be? Where's the pain? Where are those bullseyes that are sitting in the marketplace? There's the stops. Above the marketplace, there's buy stops. This is buy side liquidity. This is buy stops that are pending. Their orders are just sitting there. I don't need a heat map, gimmick thing that some brokers offer. I don't need to look at level two. I don't need to look at a DOM, depth of market. I don't need to look at any of those things. I have 30 years behind me knowing that this is where everybody's going to have their stop. This is where everyone's going to have their religious faith placed on their system, their pattern, their approach, their indicator, whatever it is they're using. And that's why the market's going to go there, because there's real orders. The market is not aware. The algorithm has no idea about harmonic patterns or supply and demand zones. Okay? That's not how these markets book. The price generates movements and price runs based on the first premise of time. If it's not the correct time of day, day of week, it's not going to deliver a specific way, whether it be bullish or bearish. Certain times the markets are predisposed to go into consolidation and range bound. That's an important factor of understanding why time is a crucial element to knowing what you're learning here. This is algorithmic theory. I'm not teaching you classic chart patterns. In fact, I will show you how those chart patterns fail, when they're going to fail. Fake bull flags, fake inverted head and shoulders, triangles. In the books, they tell you once it breaks out of these triangles, these wedges, then you go in the direction of the breakout. I don't like that because I fell victim to that. And to me, it's guessing. It's equivalent to the people that you see on social media. They'll draw a level line going up. If they think it's going to go up, it's going to go here. And if it's going to go down, it's going to go down here. I don't do that. I tell you exactly where it's going to go next. And if I don't know that, I'm saying nothing. I'm staying silent. And there's nothing wrong with that because it's about being profitable, not being right. If I wanted to be right, if my pursuit of being right was the reason why I'm even teaching, I'd be tweeting 1,000 times a day telling you the very next 1 minute or 5 minute buy side liquidity would be reaching for, or inefficiency it would be reaching for. I could do that. I could drive you nuts. But that's not the point. The point is I want you to understand how to take everything off your chart and look at the market the way the algorithm that books price. I have floor traders in my community. Now, these folks, they were on the floor. Open outcry, guys screaming, selling five, give me five, give me. They're in the trenches, or they were. Now, electronic trading, they're dinosaurs now. And it was a lot for them to transition, and some of them were unable to transition from that way of trading into electronic trading. There's a feel that you get down on the floor that the students that I'd listened to that were floor traders would tell you. You'd see the tide turning. They don't have a chart in front of them. They have the number. They have the orders coming in. What do they have to work with? The actual orders coming in the marketplace. So that was the first clue to me, and I learned this idea from George Angel. Okay, he's an author, wrote a bunch of books about trading, specifically the S&P, and I liked more about the things he remarked about that were not that many really. But when he talked about being a floor trader and his experiences being down there and how they would sense the turn of the tide, where the direction would change in the marketplace based on the order flow coming in, the fevered pitch of how much action was coming in, and they didn't need to see a chart. And I started thinking to myself, if these floor traders are making their money without a chart and they're interpreting the future price fluctuations based on the orders that are coming in, that means that I should be able to visually see where these orders are way before a floor trader even reacts to what would naturally be what when this high and this high here is taken out here, and you know what's going to happen. There's going to be a flood of orders coming in. There's going to be a fevered pitch. The market's going to be inundated with market orders coming in because these buy stops, once they're activated, they become market orders. And that intensity, that number of contracts that are coming into the marketplace that are being exchanged, that's predictable when it's down here, 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 and here. Even down here. If you look at my tweets this morning, I mentioned that there was an SMT divergence. Some of you are probably thinking, okay, what is that? I'm going to show you an indicator. Okay, this is one of my top secret indicators. You ready? Look at that. That's crazy, right? This is not oversold. This is just simply the price on a line chart on the low of the NASDAQ. Okay, you can create this on TradingView. If you're using TradingView, up in the upper left-hand corner, there's a little plus symbol. If you click on that, it'll give you the opportunity to add another instrument. So this chart here above is the E-mini S&P futures contract. And all I did was compared the NASDAQ comparably, and I clicked on New Pane. New Pane puts it down here. It's plotted on the closing. I'm sorry. It's plotted on the low on a line chart. When you first open this up and you do an overlay like this and compare, it defaults to the closing price. You don't want that. So when you're bullish, or if I'm bullish, I'm comparing and contrasting the relationship between the lows of the S&P versus the lows of the NASDAQ. And you can see how we were going below these lows here, dropped down here, but we didn't see that same thing occurring down here. We had higher lows forming in the NASDAQ. That's SMT. I mentioned that this morning in my first tweet. I said there's decoupling in the stock indices, and there's SMT divergence at the lows on on the S&P here, and that of the NASDAQ. So that set the stage for the manipulation aspect that I felt that was worth taking on the risk of going long. So if I'm seeing price, not an indicator, that's all this is, I'm comparing actual price action of closely correlated markets. I'm looking at the relationship of years, decades of experience looking at when this occurs around the opening at the opening bell at 9:30 in the morning, New York time. If I see that and there is something like this existing in price action, which is these relative equal highs, that's a smooth area in price action. The market does not like to leave smooth edges. Now, by itself, doesn't mean much at all. But when you couple that with the fact that the market's been going down, and then as this is going lower here, we've taken out a smooth area here. This is going to be viewed as what in retail mindset? Support, right? And then when it breaks through it, traders that would look for this level here as support, and they don't want to trust that it's going to go higher there, they expect it to break. They want to see that support broken, turn what? Resistance. So how are they going to be right about their trade? They're going to wait for it to come back up into this level here, and they're going to try to go short. So the traders that are in the market up here, short, they're right if it never goes back up to this level here. I'm not worried about being right or wrong. I'm looking to devour, to consume the less informed traders. And they're willingly laying their necks on my blade. They're willfully walking into the crosshairs of how I trade. They're not aware of me. They're not aware of you as my students that internalize the market like this. They're just looking at their patterns. They're looking at their indicators. They're looking at the things that their religion says should equate to profitability. But none of that stuff has any bearing on why price is going where it's going. And it's easy to convince yourself, like it did me when I had, well, very few opportunities where it panned out in my favor using specific indicators. And I know this lesson painfully because I'm preaching you what it was that I discovered how I was wrong. Because when I was doing it with these indicators and the market was predisposed to go up anyway, and I was only focusing on being a long trader, I didn't understand going short. That idea of only focusing on being a buyer when the market was likely to go up, well, it stands to reason that's the only reason why my trade panned out. It had nothing to do with the indicator, it had nothing to do with any price pattern. It was the fact that the market was going to go up anyway. So the realization I had one day, sitting in Gunpowder State Park in a hammock, looking out, reading, how I was trying to do something and forcing correct outcomes, avoiding incorrect outcomes. There's your buy side of this mention, by the way. It's one of those cherry picked moments. The necessity of holding on to right or wrong as the outcome versus am I making money? Am I consistently able to find a way of harvesting, taking money out? And the only way you're going to be able to be assured that that's going to continue week after week, daily, every single time that you sit in front of the charts, that opportunity is presenting itself, is understanding liquidity. Because if you don't understand liquidity, and liquidity is the orders that rest above highs, buy side liquidity, buy stops, or below old lows, which is sell side liquidity, sell stops. Understanding who's going to be targeted next. Why should they be targeted next? So I don't want you as my student, if you're new or if you've been here for a while, some of my students communicate grief in their results, in their tweets. They'll say, oh, I messed up, and they almost flog themselves publicly in a tweet. And I know why subconsciously we as humans like to do those types of things. You're looking for the community, or maybe even me as the educator, the mentor, the hero that you look at me as, which I'm not. You want me to coddle you. You want me to give you a pat on the back and say, don't worry. You'll learn how to do this one day. That's not how you are supposed to be doing it. You never, ever record anything negative, whether it be a tweet or in your journal or in your notes, or vocalize it, because your subconscious is going to remember that painful moment. And that's the very thing that anchors to the reason why you're fearful of being incorrect. Think about it. Social media has created a firestorm of that. Everybody's responding to what? Stimuli. You don't like me, I don't like you, that type of thing. Right here, there's your buy side next. Let me make sure I have it on the chart over here. Sorry. Getting lost in my discussion. So there's buy side liquidity at 40, 41, 50. So you're not trying to be liked by everybody. I don't feel bad when I win and someone lost. I don't have any concern for that, because when you open up a trading account, you understand the same risks that I did when I opened up mine. So if you lose money, whose fault is it? It's yours. When I lose money, whose fault is it? It's mine. But that problem of balancing and being responsible with the risk, as a new student, as a new trader, it's easy for someone to say, well, those brokers did it to me. And sometimes that's true, especially if you're trading Forex. But when you're trading a futures market, where it is what it is, everybody has the same high and low. It's a pure medium, but you're still going to be haunted and plagued by the desire to be right because you think being right is safe. No one can judge you. If you're right, you should have made money. But how many times have you watched the charts and been right, but you didn't have a trade on? So you can't argue that's the reason why it's important for you to be right, because you're not even making any money when you're right. Or even if you place a demo trade, you didn't make any money. You can't go buy groceries with that. So are you still doing things properly by placing the emphasis on being correct or right versus profitability? So you have to peel that onion back and get all those dead layers off of things that you're worrying about, which is normal. Everybody's done it. Everybody will do it continuously in the future. After I'm long gone, people that will come into this industry, they're still going to have the same problems that plague them, fearful about doing it wrong. And it's normal. You know what it was like when you made the mistake of telling your spouse, your friends, your coworkers, whomever, that you're getting ready to start learning how to trade. And they probably gave you every reason why you shouldn't do it, right? Oh man, you're going to lose your rear end. I know a guy that lost. That's the first thing. That's the first thing they're going to tell you. And what are you going to remember? That. And all you wanted to do was share your excitement about wanting to learn something new and do well. Here's a news flash for you. Your family and friends, they don't really want to see you succeed. So stop inviting them into your business. They have no business in sharing the spoils and your victories. They didn't work for it. They didn't take the risk that you're doing. They're not putting in the work that you're doing. Stop inviting them in the conversation because they're only going to bring in their perspective of why they would never do this themselves. But in your heart, you're thinking, if this works for you, you're going to help them by getting them on the same page. No, it's not a team sport. If they want to do it, and then when you succeed, trust me, you will have to beat them off you with a stick because they're going to be bothering you constantly. Hey, can you do this? Can you help me? Can you trade my account for me? My family members do that all the time. I have family members that I cannot help. I've given money. I've bought homes for them. They still lose everything. You can't help some people. In this industry, you are by yourself. Even though you may be mentored by someone like me or someone else that's equivalent, that's well meaning in terms of trying to protect you from yourself, knowing what it's like to do the wrong things, and also guiding you away from unrealistic expectations because you're expecting to be right all the time, never wrong. And even if you're wrong, that's going to be when you're in demo, not with your live account. That's unrealistic. You need to have a disconnect from the equation of right or wrong. It's about being profitable. And the number one thing you want to do is focus on removing all those distractions. And the first one in that is social media. Your Instagram, your Twitter worships, your Facebooks, whatever it is, whoever you're worshiping, whoever you're following along and lifting up on a pedestal. And this is why I strike down everybody that says I'm the greatest of all time, the GOAT, the king. I can't stand that. I'm not. I'm just a guy that's been blessed with this information, and I'm trying to help you with it. I want you to do well, but you have to make decisions along this process that either you're going to listen to everything I'm saying or the results that you're aiming for are going to be skewed. And that's exactly what I get from students. Some of my hardline critics are students of mine that failed themselves, not because my concepts don't work, because they themselves had the wrong mindset. They're impatient. They expected something that was unrealistic. And they didn't do the things I told them to do, which is what I'm putting all of you through this year. And some of you have seen that it's a lot more work than you thought it was going to be. Some of the folks that started this very first video of the year in 2023, first mentorship video, big, huge list of views, 200 some views, 200 some thousand rather. And as the videos would go up, less viewership, because they can't perform. They don't have the wherewithal to do it, because inside their mind, they're thinking, I was expecting this to be easy. And it takes them back to that fear of being right or wrong. If it's this hard, I'm probably going to be wrong. And, or ICT himself's, a scammer, because he has rental properties and, he probably sleeps there too. No. You're going to have everybody and everything give you perfect excuses why you shouldn't do this. If you're swayed by that, you're not a trader. Because come hell or high water, someone that's really dug their heels in and says to themselves, I already know this is going to be hard. I already know it's going to take longer than I probably want it to be. But I've seen enough to know that this is exactly what I want to do with my life. I want to pursue this, and I want to master myself. Notice I said master myself and not master the markets. I have not mastered the markets. I will never master the markets. How's that for a reality check? Now, I'm pretty precise. I'm pretty consistent. I can see certain things in the marketplace, and I've demonstrated that for years. My students are able to do that as well. None of us are mastering the market. The only thing we can do is master ourselves. And how do we do that? Number one, we wrestle with the idea and we hold it at bay, the idea or notion that we have to be right. Right is not always profitable, and wrong is not always unprofitable. There's many times I'll get into a trade and I expect a specific thing to be reached for. Like, for instance, we're staring at it right now, the 40, 41 and a half level. I like the idea of it trading up there, but it might require going over lunch hour before it does it. Or it might just shoot up there while I'm talking to you. It doesn't make a difference to me. I'm not in the trade, but it's an expectation I have. So if I place that in front of you, you're all watching me live. If I say I believe that 40, 41 and a half is likely to be traded to today, and it doesn't, what did I lose? Nothing. For some of you, you think, oh, he got that wrong. And you'll overanalyze. How did you get that wrong? Here's what he didn't see. And you'll bring all your retail stuff as to why I should have trusted that versus what I've been doing for 30 years. I don't care about the opinion of other people. That's not going to change my perspective on how I teach, what I use, what my students make money with. They're not looking at their bottom line and thinking how many times they were correct and how many times they were incorrect. They're looking at their bottom line growing. That's why you're here. You don't like me as a person. I don't give you fashion tips. I'm not in here showing you lifestyle stuff. You're here because you know that I'm showing you something that repeats. And that's exactly why I want you here. That's it. You're not going to have dinner with me. I'm not going to come over to your house. I'm in your house every day, but I'm not going to visit you. Your relationship with me is I'm a conduit. I'm a pathway between where you are right now and where I know you can be. Your visibility may be limited because of experience, because of doubt, the people you hang around with, where you came from. All those things are going to be factors in why you're placing so much emphasis on being correct and never get it wrong. That's unrealistic. You need to put it aside and dismiss that. Don't worry about that. That will be an impediment to your development as long as you hold on to it. I'm going to put you through drills, live streaming. I'm going to tell you, watch this fractal here, watch this move here. Let's see if it goes to this level next. And we're going to record how much time it took, how much drawdown from the time that we would anticipate the move beginning until it trades there, or where it goes to a level that would be no longer valid for that price run. For those of you that are listening, You're thinking, that's it. ICT's giving us a secret signal. Okay, that's the buy and sell that we're looking for. If you do that, if you do that, you are cheating yourself of a learning experience that you cannot get otherwise when you don't do it with money. If you place a trade based on the things I'm saying when I'm doing live streams, you're ignoring the benefit that's available by you not being swayed by the outcome. See, if I say, I think it's going to go here, and this is what we're watching the reaction here, and it should go here next, and it shouldn't go here. That's enough for someone with reasonable understanding to say, okay, he just said this is where the stop would be, because if it goes there, it's no good, and this is where he thinks it's going to go, and he's saying right now's the time it should react. So that's the buy or the sell, the stop, and the target, right? Right. I'm aware of that, but I'm not telling you a signal. I'm teaching you how to read price. And here's what's going to happen. Folks are going to go in there, they're going to press a button based on what I'm doing, and it's going to move. And then they're going to go to my Twitter feed, and they're going to try to high five me, and they're going to say, "Thank you, ICT. I just got my funded account. I just passed it, or I'm getting my first payout because I just took that trade." I'm not going to like your post. In fact, it offends me because you're not listening to me. That's the number one reason why I refrained from doing these types of things, because it's not helping you as much as you think is that little bit of a monetary push. You will not be able to do it on your own. If I stop doing it, you're going to be back in that square one of, I'm afraid if I do it, I'm going to get it wrong. Versus watching the tape with me live when we do it live over the charts, putting aside the requirement for it to be on a trade that makes money or loses money. Because if you're thinking about the money, you're placing yourselves in the same category that I attack in my trades. When I'm doing my trades, I'll many times annotate, sometimes facetiously, and say, imagine you were short here. Would you feel comfortable with your stop here? And invariably, it goes right to that area where the stop is. When I'm looking at these candlesticks, I'm reading the hearts and hopes of traders out there that are just trying to do everything they can to make money with things that will never deliver that. I can never meet them. I can't get them. I can't tweet them. I can't text them. I can't call them. I can't send them an email and say, hey, you're doing it wrong. Let me help you. So I don't have any moral dilemma here. They knew the risks. And when they lose, they'll either learn how to do it better or stop trading. Either one of those outcomes is favorable. I'm still going to sleep the same way, whether those people still have an account after that loss or not. But you, as a developing student, you're placing so much foolishness on things that are controllable. And you're not placing emphasis on the things that are requiring a lot more of your time and due diligence, which is studying without any monetary commitment. Demo, not even that, no. Tape reading, what I'm putting you through, watching the tape. When I tweet, I say, this is the next level, watch that, note that. If it's above the marketplace at the time I tweeted it, my bias is what? Bullish. I'm expecting it to go up. To what zone? No, to that level, to that price level. It might sweep through it, that's fine. But that's the level I want you to be following and watching when the tweets go out. If the market price that I'm telling you to note on your chart is below the market price at the time of the tweet, I'm signifying that I believe the next run to be focused on is going down. Isn't that pretty easy? Now, I still get criticized, and I don't give a rat's rear end, from people that just simply want me to spoon feed them. I am spoon feeding you. I have a 24 karat spoon every day on Twitter. All you have to do is show up. You have to study the things that are in my videos, and you'll see your pattern form. The thing that you're going to be utilizing to make your trades on your own, independent, without me saying anything, that will come by you watching the tape, using my experience, borrowing my experience of where I think the market's going to go to next. There's going to be times when I get it wrong, but that's going to be far less than you would have been doing it. And that's all I'm suggesting is that use it as a crutch. In the beginning, there's no shame in that. No shame at all. There's no shame in learning how to trade in a demo. There's no shame in teaching in a demo. If an educator goes out there and says, "Hey, you know, I'm responsible. I don't want to see any of you hurt, and also I want to protect myself because I'm not a licensed trade advisor." I'm not. I'm not a financial advisor. And by talking about charts like this, there was no button being pushed. In fact, I've actually told you not to do it. But the skill set of reading and interpreting price action by doing these exercises and spending time with someone that knows how to do it, whether they're doing it for the demo, whether they push a button or not, if the market pans out continuously over time, repeats, there's something there that's worth mining. There's some kind of insight that's worthwhile to extract from that medium or person. And if you foolishly place a trade on anything that I say or someone else says, and you don't know the logic as to why it's being considered as a trade, your attention is not going to be on the things I'm going to say, draw reference to. You're going to be watching the profit and loss up and down as the fluctuations occur. You're going to zone out. You're not going to hear the things that's going to be more pertinent to you to know how to do this independently because you're fearful of what? The outcome now not being profitable, and you're not going to listen to anything else. It's the same thing that everybody does when they watch a book or join a course or they follow somebody that thinks they're, you know, the bee's knees in trading and they're talking about where the market's going to go next. And you're all out there trying to line up to do trades based on whatever they say. You have no idea what made that person say it's going to go where it's going to go in their analysis or their call or signal. To me, that's the epitome of gambling. You have no reason why you should trust that. What's the logic? Contrast that with me. I'm literally trying to explain to you why these price patterns should form, when they should form, how you can trust them when you know they can fail. And I'm also teaching you in certain instances, there's an environment that you don't want to be taking a trade in because the risks are too high versus the potential reward. That's a skill set that you can't learn from a book. You have to be side by side with someone. There's no way that there's literally no way to learn that except for walking hand in hand with someone on a daily basis, a weekly basis for months, you know, in my opinion, a full year. You'll appreciate managing the risk more appropriately by doing it. And at the end of the year, you're going to look back and say, you know what? I'm glad I didn't push myself into trying to trade before I was ready. I'm confident that there are going to be many of you that won't listen to what I just said. You're zoning that part out because you need to make your ends meet. Groceries are more expensive, bills are going up, rent's higher, gas, electric, natural gas, even eggs. 400% increase in egg prices. I get it. But you can't speed up progress. You can't. Your progress is going to be uniquely your progress. And don't measure it against somebody else that you may be seeing do very, very well. You might see someone that you're friends with online. They came to the same place that you're at right now. They're trying to learn this stuff. Great. And they may do far better faster or give you the impression of doing it better. And you might think, well, that means I'm not good enough. I'm not a good enough student. I must be slower mentally than that person or everyone else. I have students that started with me in 2016, paid me money, and learned the same lessons that people that are making money right now learned, but they can't do it themselves. And the common denominator is how much they put into it, what they're holding on to in terms of fear, just doubt, and just doing the work. And the work is sitting in front of these charts and watching price action. You might not be a trader that has the ability to trade intraday. May not be within the realm of, well, possible for you. You might need to trade a higher time frame. Don't discount what I'm showing you, because everything that occurs in these 1 minute charts is applicable to a daily or a weekly. It's the same things. It just takes a lot more time to pan out. So there's no reason for you to have these unrealistic expectations about being right or wrong. It's about being profitable, and your ability to be profitable, once you latch on to whatever it is that I'm teaching that you like. It might not be a fair value gap. It might be an order block. It might be the breaker. That's your only model you care about trading. That's it. That's your multiplier. That's the thing that you're looking for. Okay. What's wrong with that? Just because your entry is going to be different from somebody else, you might make less on your trade than the next trader. Is that trader going to give you any of that profit? No. Is it realistic for you to expect them to do that for you? No. You should be content with enough. If all you do this year is develop a skill set that allows you to reduce some of your overhead costs living day to day for you and your family, is that not a success? How many of you considered that? That was the reason why I made that ends series on my YouTube channel. To ground some of you younger folks that are just so worried about going out there trying to get Ferraris and Lamborghinis and such. They're fun. I get it. But once you own them and everybody knows you have them, nobody cares anymore. And you're still stuck with the insurance, the upkeep, and the worrying about somebody scratching it. And you're never going to want to park it somewhere and walk away from it, because those types of things happen. More money, more problems. Reverse it and say, how can I use this skill set to help remove anxiety? Whereas right now you're using it as, this is the reason why I'm anxious. This is the reason why I'm having anxiety, because I can't figure this stuff out. When you just need to relax and understand that not every single moment of the day is an opportunity, and it's not realistic for you to see it. You're still learning. But being fearful of the outcome is always attributed to because you have money on the line. That's not to say that when you start trading with live funds, should you decide to do so, that you shouldn't be concerned about the risks. Yes, you should be. But it shouldn't be paralyzing. I'm about to work with my son Cameron. I mentioned the other day, he said he wanted to do a funded account. He watches my videos, and obviously you see the advertisements. People, run ads on YouTube, and he watched this Top Step thing. I have no affiliation with Top Step. Okay, I'm just being open with you. I know my son said he wanted to do it, and he does not want to have a Twitter account, doesn't want to have a YouTube channel. And frankly, I think that's great. And his words were, I don't care about anybody else liking me, Dad. If I can make money with it, that's all I care about. How proud, how proud was I hear him to say, say something like that? Because, you know, I don't see that as somebody that's selfish and greedy. That's someone that's got it figured out early on. If you're going to do this, only do it because you want to make money. I don't care who likes me. You shouldn't care who likes you. Do you think it's going to matter when you figure out what you're doing and you conquer this fear of being right or wrong, and you're able to find consistency? That means making and losing money, but over time, you're making more than you lose. That's trading. Do you think that anybody is going to convince you that you've wasted your time when you start making money? No, you're not even going to give them the time of day. And to hear my son say that he's not interested in that, he only wants to make the money, that's the proper mindset. But he admits that he has a fear, which is reasonable, of pushing the button. He goes, I can see that fair value gap, but I'm afraid if I go in and I push the button, Dad, I'm afraid it won't pan out for me. And I don't want that transaction to be painful. He plays video games. So he's trained himself, conditioned himself into what? New high score all the time. New high score all the time. New high score all the time. And that's fine for video games, but this is not video games. This is financial ruin if you let it happen. So it's important for you to understand there are times when right or wrong is important, but right or wrong isn't terribly important while you're learning. You need to learn how to balance that. And one of the things that I'm going to teach him, and I'm going to teach you all as a result of being a part of the program with my son being a developing trader, is that I'm going to put him into situations where I desensitize him. I was afraid of putting on trades like that too. And hearing it come from my experiences, it only has so much help. So I have to show him how to desensitize yourself from fear of doing it wrong. We will be doing live streams. I will. I mean, I'm thinking about this because I know there's people out there saying I do this all the time. I do reset my account for other reasons, but this is the demo account that I showed you guys the other day. I saw some joker say, "Oh, he blew his account. That's why he's talking about something else." Huh? Let me scrub this up here. Now I tweeted. You can see all the dates and stuff here. It's only been 2 trades. This is nothing. It's paper trading. It's stupid. Okay, but I'm gonna reset this account. Okay, to 50,000 because I'm going to be working with my son Cameron. He wants to get a $50,000 Top Step funded account. That's his goal. That's what he wants to do. He works a job. I make him work a job. And it's important for him to make his own money. If I just dole out money to him, which is what I've done with one of my children, and it did not help. It made things worse. So now, because of that experience, I don't have the shame and guilt that I felt by having a lot of money and not just giving it to them like I wanted to do when I was a younger man. By making them work for it, it conditions them. It's work hardening. It's important. That's what gave me the work ethic that I have now. But he has this fear of doing it wrong because he's viewing it like a video game. Because in this, if you lose your account, unless you have more money to put into the account or reset with these funded accounts, I think that's what they call it, resetting it. It's something like that. Well, where if you blow the account challenge, whatever, you pay another fee to start it up again. So if it's not reset, I'm saying it wrong. I apologize, but he doesn't want to fail and do it wrong, and it's in his head about pushing the button. So I'm going to teach him how to desensitize himself. I'm physically going to be on live stream. You'll hear me talking to him. Now, I'm not going to do it daily, but I'm going to force him, and you all will have the benefit of hearing me tell him exactly, this is my flesh and blood. This is the the son that was given to me on Valentine's Day, the day I was married to my wife. He was supposed to be born on March 5th, but the Lord seemed fit to give it to him, give us him that day, which is great. I'm not going to give him advice that I don't wholeheartedly subscribe to. So that way you can trust the things that I'm teaching you. I'm talking to him right now. This entire discussion has been to him. But you think I'm talking to you. All of my videos are to my children. And when you watch us and listen to me and him engage over live data, and I'm trying to tell him, do this right now and tell me what you feel while you're doing it. For some of you, it's going to be very entertaining. Others, you're going to learn a great deal about yourself and how you see price as it's happening live. And I'm going to try to get him to be honest and tell me exactly how he feels in his own words. He may or may not do this because, he's about to turn 18. He's Mr. Macho. You know how teenage boys are. He's way bigger than I am. He looks like a freaking linebacker on an NFL team, but he's a softy at heart and he doesn't want to be judged. So I believe he has the makeup in him. If I turn him into a savage, he will be a menace on social media. If any of my kids are going to be like that, it would be him. But he's also cognizant to the fact that he is not there yet. He wants to be, but he's also admitted to his father that he's scared to push the button because he doesn't want the results to be negative, and he doesn't know what that's going to feel like because he's doing it with quote unquote potential to make money. Now, this same son of mine has only listened to me about trading. He has never sat down, ever. Never, ever, ever sat down, did it on his own, started a demo account, and started working it up. He's never done it. He has next to zero experience. So if he gets out here and live and he does this and he flounders in the beginning, that's exactly what it's like when people do it. It doesn't matter if ICT's his dad because he's going to push the button. I'm not pushing the button. So it's a matter of grinding your way through it. Because if I pass away and he doesn't learn his skill set, then guess what? He's stuck where you are. It's only in the videos. And I want my youngest son to learn like he will hopefully see Cameron do it and understand that he had fear, he had anxiety about performance anxiety. You know, you want to do it, but you're attributing the failure and success on an individual event or transaction in one trade. And that's what makes this difficult because everybody can afford to lose 1/4 of 1%, no matter what they have in their account. If you can't, then you shouldn't be trading. Yes, I said 1/4 of 1%. When you're learning how to trade with real money, that's where you start. Not 2%, not 1%. And the folks that are out there saying, you can't make money with a $50,000 funded account or a $50,000 trading account or with 1%. These same people don't know how to trade, period, because you're basically saying you don't know math. How can someone say that you can't make real money with 1%? Now, are you saying you can't flip your account every month or every 3 weeks, risking 1%? Then yeah, I agree. That's a true statement. But you can make 6 figures a year making trades with less than 1% in terms of risk. Not saying you're only making less than 1%. I'm saying to incur risk or open yourself up to risk at 1% or less, you can still make 6 figures a year doing that. How can you do that, ICT? It's math. All you're going to be doing is looking for something that repeats over and over again. You're looking for your cookie cutter, but right now you're afraid that your cookie cutter isn't going to give you the cookie that you want. That's why you're fearful of it. You have not handled it yet. You have not worked with it yet. You have not seen it perform in price data that's live. And it will desensitize you and remove all the doubt that you have right now. You're fearful that you can't do this because you haven't handled it yourself. Most of you are sitting on the sidelines and waiting for me to do these live streams, call moves, call this, call that. And then if I do it right, most times, then you're going to take the initiative to do it. Okay, it's fine. That's normal, I guess, in a lot of ways. But there still will be people that even when I show them results, they're not going to be willing to do it because there's a barrier there. And it's not with me, it's not with the content, it's not with the concepts, it's in them. And you have to press into that. When it feels uncomfortable, that's exactly where the growth occurs. That scary feeling of, I see it there. I know it's only a demo. I'm going to push the button, but I don't want to see the bad result happen because it's just going to make me feel like I'm never going to learn how to do this. That's exactly what you press into. You press into that moment right then and there. There it is. And you log the experience without having any of the negative self-talk. You always positive self-talk. You find the silver lining in everything and you record that in your journal. You record that in your charts, in your annotations. You never emotionally charge it with a negative link to a bad reaction or you know, regret, because your subconscious remembers that. And it will be an impediment to you pushing the button when you need to on the next trade. That will be perfect, but you will be thinking and beating yourself up mentally, and social media invites us to do those types of things. You don't want to do those things as a trader. You want to guard your mind, filter in only positive. If anybody out there is toxic, they should be removed from your attention. If I am a distraction to your trading, don't follow me on Twitter. If you already know how to trade and you know how to use my concepts, the worst thing you can do is listen to me on Twitter, because I might be looking at a setup that would be contrary to yours. And I have students have done this. Man, I wish I never would have saw that tweet, because it made me second guess my trade that I'm in a larger time frame, and I got out too early, and I would have made this much more. Yeah, whose fault is that? It's not my fault. I'm teaching. I'm not aware of your trade. So you need to be responsible with your actions or inactions and own the results. If it's good, you earned it. If it's wrong and you did something incorrect and you have an adverse reaction, you own that too. There's nothing shared in trading. I have students out there making real money. They're not sending me parts of their winnings because they feel like they owe me something. They earned that. When you do this work, you get all the results and you own it, good or bad. But being fearful of the outcome is rooted in you not knowing what it is that you're trying to do. And you're trying to make that like a boogeyman scenario. Like you're going to be a victim of something outside of yourself when it's just you. You. Your broker didn't make you push the button. I didn't make you push a button. Your spouse and your circle of influence, friends and family, co-workers, none of them forced you to put on a trade. None of you will ever be able to justify your pushing of a button on anybody else but yourself. You own that. So doesn't it make sense for you to desensitize yourself from the experience in the beginning, doing it the right way by not having money attached to the transactions, studying price, getting a close read on price, and knowing when not to trade, when to close the charts and be done, and not being fearful of missing out. If any of you are in the listening audience right now and you've put on a trade, maybe you took a couple trades and you made money, the times I tell you in Twitter to close your charts and turn them off, doesn't that feel like I'm asking you for your firstborn? What? I might be able to take another trade. I need to get my funded account challenge finished. I just need that $5 more of a move to get back that last bit of drawdown. It's a Friday, ICT. I gotta do this, or I'm not gonna be able to live with myself this weekend. I'm not gonna close my charts. I gotta go in there one more time. That fear of missing something. If you feel that, that's infancy as a trader. That's not maturity. Maturity is knowing that you have the discipline to follow sound advice. I'm not saying there isn't going to be fluctuations in price. I'm just saying, do you have the discipline to say, this is enough? Close the charts. I'm inviting you to forge discipline. And some of you, most of you, if I'm being honest, doesn't register as sound advice. You think I'm just, oh, well, that's he's done, doesn't mean I should be done. No, I'm teaching you to remember there's a time when you can be content and close the charts. Then you're not inviting the wrestling match that happens with, I need to be right on my trade. And you know what it feels like when you still keep your charts open and you go out there and you wreck yourself. And then you tweet to me, or you want to tweet to me, but you know I'm going to say these types of things to you. I told you not to do that. Everything I'm doing and saying and teaching on is meant for my children to do well. You are all guests in my house. That's it. That's the way we do things here. I'm teaching my children. You are just invited into the conversations. But when you make bad decisions, much like my own children will do it, they're going to be told the same way. Eat it. It's good medicine. It's going to help you become the trader that you don't even realize is in the making. That formidable, profitable, consistently sound logic, not afraid, not swayed by emotions. You know exactly what you're going in there for. You know why you're doing it, and you know where you're going to be wrong so that we can measure and define risk. You're going to weather losing trades. That's fine. That's normal. Every trader has losing trades. Every trader has drawdown. Better traders control drawdown and mitigate systemic drawdown. Those are skill sets that you learn by getting in the trenches and being in these charts and pushing a button. But you want to learn those lessons when there's no money attached to them. And most of you are attributing being right or wrong in the fear that of being wrong because you're trying to do it with live money when you're not even ready to trade. You have no idea. Can you honestly say, and be honest now, think, can you find 15 profitable setups between now and the close of the month of January? Do you have the experience in you to know that you can absolutely frame that many high probability setups between now and the close of this month? If you can't do that, why on earth would you be worrying about the transactions being right or wrong and having so much emphasis on it? You're placing unrealistic expectations on yourself. I don't ask that of you or any of my students. So why are you asking of it? You're asking to be a gold medalist Olympic trader because you watched a video series by me. I don't expect that of you or my viewers. But that's the equivalent of what it is you're doing. It may not feel like it, but that's exactly what you're doing. And that's irresponsible, it's unrealistic, and it needs to stop because you're holding up your progress by doing those things, thinking about it like that. So when we tape read this year and we're watching price action and I'm taking you through the charts on Twitter, you need to be engaging and not thinking about how much money I would have made on that. That's the worst thing you could have done. Worst thing. Because you are not taking advantage of the time I'm investing in you by showing you how to read the tape, watch these candlesticks paint, and you have no outcome to worry about. You're not going to make any money on it. You're not going to lose any money on it. And you have all of the focus on what? Reading how price behaves between the time I send a tweet and when it hits the level. There's lessons in that that I can't even articulate because it's going to be on an individual, unique basis. You're going to discover, wow, I really am impatient. It took 11 minutes for the trade to go there and it felt like a lifetime. I'm really impatient. Yes, that's what this market will do. This market is a mirror. It's going to show you every character flaw in you. And you can try your best to try to ignore it. Pretend it's not there, and it will just compound and show you in reckless trading. You got a superiority complex, you're on social media, you're going to try to be better than everybody else, and you're going to break every sound logic rule in trading. You're going to over leverage, you're going to martingale, you're going to push, and you're going to say, I should stop, I know I should stop, and you're still going to do it on your live streams and roast yourself. These markets are a mirror, and they're going to show you and the world, if they're watching, the real you. And if you're new and you haven't even discovered how to trade yet, why would you invite other people to cast their judgment upon you when you don't even know who you are as a trader yet? You're trying to rush to do too many things, and there's more important things to be worrying about. Sound logic, patience, knowing what to look for. What do these patterns look like on a day by day basis, week to week? Over time, what that does, it's a desensitizing event that you see these things panning out. It doesn't mean that you should be expecting to see the same thing when you first find me. Some people, I've watched your entire series. I studied all your videos, which means I watched all of them, and I'm still struggling with bias. Okay, that's what this entire year is going to teach, bias. I'm trying to figure out how to find the right fair value gap. That's what I'm doing this year. Hear the last word in that sentence? Year. You will not learn the correct bias or narrative in watching one video series. I can't write a book. I can't condense it into a 5-minute trainer. Nobody can. You have to walk it with me. You have to see it daily, weekly, over months throughout this entire year. And then you'll be able to reflect back on all the journal entries, all the times, the events that we walk through live, either on Twitter or on live streams. You'll have that experience, and it'll mean more to you because you walked it, you lived it, you went through it. And some of you are kicking and screaming, I don't want to do it, ICT. And damn it, you're not going to make me do it. Right, okay. Stay mediocre and unprofitable because that's what you're saying. Because whether you realize it or not, long term continuous success in trading is doing this anyway, every day. You think you're not going to be looking at charts? How are you going to make money? I don't want to watch data. I don't want to watch the charts. I don't want to back test. I don't want to do any of that stuff. What? How are you going to trade? How are you going to find the setup that you're looking for? You got to put your nose in the charts. I ain't got time for this. Right. You're saying that you are in a hurry to lose. You want to fail. You're on the fast track to failure. Go ahead. Have it your way mentorships are out there. Do it. I'm here and I'm talking to the folks that are ready to learn. They're not expecting pie in the sky results real fast. They're not trying to get Lambo lifestyles. Now, you can get that real quick. Learn how to trade and then make your analysis available to other people. They will pay you gladly for that. And you will make millions of dollars doing that real fast. You can get Lambo life just like that. So if that's really what your passion is, put the work into it, learn how to do this, and there's lots of other people that want to copy whatever you think is going to happen. If you're consistently profitable, your analysis is correct, believe me, there's more people on this planet that are willing to pay you for that skill set than you can take as trades. And you can make more money doing that. And this whole argument, oh, if you could do it, you wouldn't teach, you wouldn't charge money. That's bull. That's bull. Okay? If I needed to make a lot of money, if I needed to make a lot of money real fast right now, all I got to do is put a PayPal link up and say, here, join my mentorship. I don't need to do that. I'm teaching you to trust me. I am not selling you a mentorship. I'm giving you my life right here for this entire year. I'm pouring it out. I'm giving you the experience. But don't let other people tell you if this is what you want to do, that you want to go out and you want to teach what the market's going to do next using this newfound skill set you're learning. Don't let anybody tell you that's something that you should be ashamed of. Get your bread. Get it. Because these same people that are going to criticize you and cause you to doubt, they're not going to be there handing out something when you need it. When your utility bill is high, you can't pay it, they're not going to help you. So why you give them the time of day worrying about it? It's the same thing you're doing to yourself when you sabotage yourself. Doubting. Oh, I got to be right. I got to be right. No, you don't have to be right. You have to be responsible, knowing what it is you're looking for, and it has to fit your personality. If you're trying to find a model that I'm maybe even covering, later in the year, you might even see me talk about in this move here, I expect this type of price action, and this model is XYZ. If it doesn't resonate with you, don't force it like you have to because I maybe did something correct and it panned out. Don't do that. I have people that have never left the simple optimal trade entry pattern, which was my flagship pattern on this YouTube channel. Even though I've taught everything, new fair value gap model, the whole core content from the paid mentorships up on the YouTube channel, and they have still never left optimal trade entry, and that's what they make their money with. Hey, you are the poster child of who I'm trying to represent here. They're not influenced even by me. Once they find their model, they don't care. They might watch my stuff, but it isn't changing anything, right? It's not having any impact. They're not tinkering with what already works. When you buy a new sports car, if you pay a lot of money for it, how quick are you to want to open the hood up and move things around underneath the hood? I ain't touching none of that stuff. I don't understand it. I ain't gonna shame in telling you. I'm not tinkering with something that is already perfect as the way it is. So when you find your model, you find your approach, don't let other people, whether you know positively or negatively, let them have no impact on your trades. None, nothing, not your model, not anything. Let me talk about this real quick. NASDAQ is really, really, really sloppy here. Really sloppy. Gun to my head, maybe a higher high looks likely on this one. I don't know if it wants to run this high here on the 15-minute time frame. Let me just drop a line on that. I'll refer back to that later on. My stomach's talking to me saying it's time to have lunch. Let's see here. Take a look at the Dow. I don't trade this instrument, but I do use it for like the dollar index when I'm using dollar for like a barometer for Forex, which I'm not actively trading anymore. I know some of you are upset about that. Oh, the right Forex. So hopefully, when I'm teaching my son Cameron, and I'll put him through exercises, you can take those same exercises and utilize them as well. And that way you can, in my opinion, try to build the tolerance to resist being fearful of the outcome of a trade or an idea. Some of you are just plagued with, you don't think you deserve to learn how to do this. And some of you are afraid of success. As weird as that may sound, that's exactly what some of you are fearful of. Is it going to change you as a person? It will. And it takes a whole lot more energy and effort to resist being ugly. And when I started making a lot of money when I was a younger man, that really made me arrogant. And you have to be careful with that. And it's something probably that you should be concerned about if you're a young person, especially a male. Females, not so much, but the males tend to be, braggarts and want to show their peers that they're worth listening to. But I'm going to cover what I did this morning, and then we'll close this one because I could turn this into 4 hours easily and probably bore the socks off of you, but I want to make it useful. So if we have the you can see it's not a market replay, by the way. So we had the SMT divergence down here, and that is here. We have the lower lows, but not seen in the NASDAQ. You see that? So this is an SMT divergence. And what this is, what's actually occurring here, as the S&P market is dropping lower, it's going below this sell side liquidity here. So I'm going to annotate that real quick so you can see and follow the logic. It's what's going on in my head as the trader. Below here is sell stops. Okay, so that's what we call sell side liquidity. So the market taps into that here, and then once more here, and right there, we're getting divergence between the lows of the NASDAQ, and I'll show you what that looks like with the candlestick real quick. See how we went lower here? This low, this low, this low, respectively. On the NASDAQ, it's higher each, okay? So it didn't make a lower low on this pass on NASDAQ, which is the lower chart I'm pointing to, at the same time that the S&P went lower. So that's what I call SMT. SMT, I've never really settled on a name specifically what the SMT stands for. I've interchangeably used smart money technique, smart money tool. Okay. And that's why it's always just referred to as SMT, because otherwise I would have had the full 3 words as the name. But creating a language for y'all when I was on Baby Pips, uh, that's what we settled on. And that's never really changed. But that divergence there was enough for me to look at this liquidity as a raid, especially if we run a short-term high, which is what we get. Let me minimize this. That short-term high right there, it runs through it there. Once it runs through it, let me zoom in a little bit more. All right, this short-term high right there, we run through it there, that candle. So we have technically a shift in market structure that's bullish. Now, a shift in market structure, this is for your notes. Oh, you didn't bring a notepad. Oh, send yourself a text. A market structure shift is just a short-term change in market sentiment, and it will deliver on a short-term basis. A market structure break is where the entire tide of the marketplace changes and we go into a longer, higher time frame delivery of price, where if it's been bullish and then we have a break in market structure that's bearish, then what we're saying is there's a change in trend, if you want to call it in retail logic. A shift in market structure is not equivalent to an outright reversal. It's just a change in short-term market sentiment. And that's all we need to capitalize on in terms of intraday price action. So when we see the short-term high changing here, right there, that candle, once it passes through it, I never, this is for your notes also, a shift in market structure does not require a higher close above the short-term high. It just needs to trade above it. The algorithm is not basing its next run on price because it closes above that. It just needs to run through it. Once it does that, that trigger now starts a macro. A macro is a short list of instructions that the algorithm will run, and the price engine that creates these fluctuations in price. It matters not how much buying and selling pressure. That's a misnomer. It's a lie. Okay, that is not how these markets book. I don't care who tells you otherwise. Okay, it's not the volume. Because if it was the case, then why do we study volume? And price is going higher, making higher highs, but volume is receding, going lower. The volume didn't put it up there. It's being booked there. It's being priced. It's being offered there. Regardless of how many people buy and sell, it doesn't matter. Markets do not top because it runs out of buyers. And it doesn't bottom when it runs out of sellers. You have been lied to. I know it's hard to take that. It sounds, what? There's no way this guy. I'm telling you, spend the rest of the year with me. You're going to be convinced of it. I promise you, you're going to be convinced of it. In fact, hold me to it as a challenge. I guarantee you I'm going to convert you, at least in that respect. So once we get below the sell side here, we run through this short-term high. There's a shift in market structure. Now it's bullish. So your eye goes to what? My eye goes to where's liquidity. So the first thing I want to look for as I pan back is I want to look for, is there a relative equal high, something smooth? Well, these highs are basically almost the same, right? So it feels like a ceiling. If you're in your room, if you're indoors right now, look up. You see the ceiling where you're at? That's like being down here looking up to the ceiling. That's the ceiling right there. Retail thinks that's the highest it can go because that's what the books tell them. They say in their mind, okay, this is the highest it can go because that's resistance. I train you to think it's going there and going above it because that's exactly where the money's resting. That's where the victims are holding up signs. I'm heading to Loserville. Give me a ride. Okay, that's a hitchhiker I want to pick up every time. When the market trades down to the sell side here, and then I'm watching, does it shift bullishly? There's a shift in market structure with that candle right there. It does not need to close above it. So now in my mind, I go back through what just took place. Well, we just ran sell side. We have SMT divergence, not using an indicator, just comparing correlated markets. The Dow, the NASDAQ and the S&P. I'm comparing the price action between those three. I'm sorry, those three instruments. If I'm anticipating the likelihood of something bullish, I'm already expecting the SMT. I'm not using the divergence as a trade selection. It's a confirmation tool. It qualifies something that I had already anticipated. This was too smooth. We were going below sell side. We went through it. If it went through it and we didn't diverge, and if the NASDAQ made lower lows with the S&P, then I would not expect this. So now some of you are probably thinking, can you just tell me what you were trusting and what you wouldn't have trusted? I just told you. If the NASDAQ would have made a lower low like it did here in the S&P, I would not have gone long even if it went above that short-term high here, because then I would have expected this fair value gap to be something to be monitoring. But because we had that divergence with the NASDAQ lows not meeting the lower low that we see in the S&P here, then I want to watch and see, does it show its hand to me? Does it tip its hand to me and say, Michael, this is what I'm about to do. I'm going higher. Get on board. I'm going to give you a fair value gap. It runs above the short-term high here, there, and as it's coded, just like it's supposed to, this candle's high. Look at this price here, okay? Right up here. This candle's high, and this candle's low. That's what I'm framing here. That's the fair value gap. Now, it drops down. What time is this? 9:45. That's when I told you the news was coming out. Now, that news report, I'm not afraid of that kind of report. It's not the same thing like a CPI. CPI will rip your face off. Like it's you do not ever, ever, ever want to be trading ahead of the CPI number. Ever. You don't ever want to be trading ahead of a rate announcement. Ever. Because it will tear your limbs off. You don't want to do that. But other market reports, they will just be fuel to something you already anticipate and see. So this 945 candle, notice it does wick through the fair value gap, but does it take out the low? No. Your stop could originate here at that low, buying this candle's low. That's your first entry. You can use that. You can use the consequent encroachment, which is the midpoint of the gap, which is this one candle. So when I'm talking about things on Twitter, I'll say ES 1 minute chart, and then I'll give a 09:42. I'm not saying I did it for this one here, but the other ones I'm going to refer to, I did. If I'm telling you 09:42 and I'm telling you 1 minute ES, I'm telling you to look at the ES chart, find that time on the axis at the bottom of the chart, and put it right on that candle, and you'll see exactly what I'm looking at. I won't have to say this is a buy. I won't have to say this is a sell. I'm just saying watch that. Note that, because you want to annotate that in your chart, and then watch how price reacts and goes towards what we're looking for, which was, I tweeted after the SMT divergence, I said, note the 40.28 level. That's buy side. So the market dips back down into this area here on the news, comes back up, and the candle closes here. The next candle opens, trades one more time. What's it trading into? The fair value gap one more time. This is the only other opportunity you have. If you're going to be using that fair value gap, you got to buy it, smack it right as it goes into that candle's low right there. It goes a little bit past it, but not much. But what is it really reaching for? Look at this wick from the high, from the low of the body, which is the closing price, to that low. Eyeball half of it. Boom. And it's also inside the fair value gap. When you watch me talk about price live, you'll see me refer to these things as they happen. And you're going to be floored how it respects and responds to many of them. I'm going to get it wrong. Don't get me wrong, because I'm looking at 1 minute charts. 1 minute, there could be something that happens, a little flurry of something that comes in, and I'll be off. Okay, no problem. But I have no fear of doing it with you, showing you that this is what you can do. Then it rips through this short-term high. This is a bullish breaker. What is that? The low here makes the high, and then a lower low. So this move up, you were focusing on the highest up close candle. Extend that range out. So as it's digging into this here, this is a return into that bullish breaker. If, okay, this is what some of my trolls and detractors like to say. Oh, this is only an old high. It's resistance, broken, turn support. Here's how you classify retail support resistance as the real levels to be trusting, okay? If that high has a low prior to it and a lower low after it, after this high forms, then it comes back down to it, then yes, you can trust it as resistance, broken, turn support. The narrative behind why it should be that way is what makes my breaker the breaker. It broke anyone that was holding stops below here. It went lower than that and then ripped through this short-term high. This in itself is a shift in market structure. Notice that? Same event is occurring with this short-term high here when that candle passes through it, is occurring with this high, with this movement right there. The logic is that we've done damage with this candle being a high here. It took out and broke. It broke the backs of anyone trying to go long on that low. When it ripped up higher like this, then it went down one more time to knock them out. There's liquidity taken here and absorbed. What kind? Sell side. Who would want to take out sell side? Individuals that want to go long. Smart money. Buying those sell stops up. They're being counterparty to it. And then using the fair value gap as it drops into here. And then one more time here. And it rips through this short-term high here. Let me take this off. And it comes right back down into that high. But more specifically, it's a bullish breaker. And old high, yes. And there's a fair value gap right there. You have three things qualifying that level. Now compare and contrast that with the Larry's school of logic in trading, retail books. They're cherry picking levels in the past. Look at this trend line. It's diagnosed. This is how you could have bought this. I bought all that stuff in the beginning. I thought that's exactly what people do. And I thought that was how it was going to be profitable for me. And I couldn't make it work. So I had to go in and figure out really what's going on. So when we trade back down into this high with the fair value gap, and it's a breaker, look at the perfect close. Look at this right here. Look at this price right there, folks. Watch that price. On this candle's high, what is the high of that? 4020.50. This movement back down into the fair value gap, what's the low of that candle? 4020.50. Folks, listen. I'm not aware of where you're at, what neck of the woods you're from, what country you're in, okay? But perfect is perfect. It's not a fluctuation short. It's not a fluctuation past it. It's dead ringer right on the actual tick. I'm sorry if it hurts your feelings, if it doesn't line up with your treasured guru mentor, okay? I'm sorry. But this is it. This is the thing you're looking for. You're looking for something that works, that you can trust the logic behind it, and you want something that is delivering with no opportunity to improve upon. This is it. This is the reason why I talk to you the way I talk. And it sounds arrogant, but it's just confidence. I know what I created. I know what I'm holding in my hands, and I'm giving it to you. All you have to do is spend time with it. And you'll fall in love with it. I promise you. I promise you, you will fall in love with this. But if you sit on the side and just hold on to your fear and struggle with the work ethic that's going to be required to learn it, then obviously, yeah, you know, it's easy to cast judgment because it's easier to talk about something you haven't really worked for. But everybody that's worked for it and that's got it, they don't care who believes me, who doesn't believe they're doing it. You're not going to either. But you're never going to get to that stage until you press through. This right here by itself is a trade. It moves from 421.50, which we'll just do the low. You could have went long on that at the low using the logic I already taught. I'm not cherry picking anything here. 40.21.25. All it has to do is trade to that level there. You could be a buyer. From 40.21.25, right there. It doesn't even have to go into the old highs back here, which is what it was going to be aiming for. But this candle here, as soon as it trades to 26 and a quarter, right there, that price right there, bumping above these relative equal highs right there, that's 5 handles. And you don't need to be right about trading to the buy side liquidity. That's the difference between worrying about profitability versus being right. You can be a buyer down here on the breaker in the fair value gap, run the short-term high and not need these highs to be taken out. If you can get 5 handles in that, guess what? That's exactly how you start. That's how you start. That's your first rung objective. Your expectations on what it is that you're trying to do as a trader, that's what you're trying to do. Know where it's likely to go, what you're reaching for. Where's the market more likely to go? I'm giving you that with my tweets. I'm telling you. I'm telling you where the market's likely to go to next. It won't be 100% of the time. Nobody's 100%. I'm not. I've never said I was 100%. But I promise you, you're never going to find another person walking this planet that's going to be as more precise as I am. And that ruffles feathers. And I don't care. You got something that's better, bring it. But 5 handles is an easy, low-hanging fruit objective. But once it clears those buy stops here above those highs, right in here, paid the trader. That was the tweet that came out. 40.28 hit, done, booked. It's over. Move to the sidelines. But what if it, who cares what if? That's not the next trade. And that's the other thing I want to talk about. Every time I do something and I call it and it pans out, there's always this flurry of the same people. Franklin, does this mean that we're going to go short now? Like I'm sitting here buying and selling every swing high. I'm not doing that. I can. I've done that before. But that's not what I'm promising you this year. I'm promising you how to go in, find low-hanging fruit. Something you can go in there and get 5 handles. 5 handles. 5 handles on one mini is $250. Do you make $250 in a day working your job? I'm not trying to be rude, but do you make $250 a week? In some countries, you aren't. And you don't need to have these extremely irresponsible mentors out there trying to tell you that you could be making 6 figures a month, or that they're aspiring to make 6 figures, and therefore, because they're saying they're trying to do it, that means it should be realistic for you to try to do. I don't do that, folks. What I'm saying to you is, what if you could just find one of these per week and had the diligence and responsibility to stop for the week, and you did it every week, every month? Wouldn't that help you with your utility bills and your maybe your car note? How much of a life-changing impact would that be to have that thing off your neck every month? If that's all you got, your grocery bill was paid for. Wouldn't that mean a whole lot more to you in terms of building your confidence to keep doing what you're doing and grow from that same 5 handle? Yes, it would. And if you're saying no, it wouldn't, turn this video, don't come back to my channel again, because you are a gambler. I cannot work with gamblers. I'm not trying to promote gambling mindset. I'm not trying to promote somebody get rich quick stuff. I'm not teaching that at all. But listen, if you take the things I'm showing you here and you want to get rich, who's stopping you? I'm not. Nobody else would be. Only you are. But I'm not teaching you that. I don't want you walking into this thinking, I'm promising you getting rich. I'm promising you you're going to work your rear end off, because you have to overcome a lot of these character flaws that you're going to have, that you don't even realize you have. But you can make this into whatever you want it to be, big or small. Now over here, this low here, this random reaction. Let's take a look at the hourly chart here. All right, so I tweeted this also. I said, pull up on your hourly chart, your 60-minute chart, the Monday 23rd of January's hourly candle. Note that that's a fair value gap. Okay, that rectangle is the same rectangle that's being shown over here. This chart that I'm looking at, the big one on the right hand side, that's a 1 minute. This same market is over here just being viewed from an hourly chart. So every candle represents the interval of the highest high and the lowest low of each hour. The candle on the bottom lower left, each candle represents the highest high and the lowest low of every 15-minute candle. You can see that rectangle here. If I take it off, watch, it disappears from the other charts. If I control Z, they'll go back. So it's going down to that level based on the hourly chart. It trades down to it here. It trades down to it here. That reaction is what I tweeted. I said, note that when we were inside the fair value gap here. I taught last night that you can look for inversion levels. If you extend the fair value gap in time, look where the bodies are collected inside the fair value gap. It trades right back up to this candle's low, does it here, hits it, hits it, hits it, hits it, breaks lower. Goes exactly where I said in a tweet on Twitter, the hourly fair value gap. There's 5 handles there. So 10 handles offered without really expecting a lot in terms of risk. There's risk every time you take a trade, obviously, but in terms of movement against the idea that once I tweeted it, very little fluctuation or what would be considered drawdown. The market then rallies, returns back up into the area of what? Let me go make this larger again. It returns back to this pool of liquidity there. Then it comes right back down into this right here. Take this off. This candle here and this candle here is one order block. An order block has nothing to do with the depth of market or level 2 data. It has nothing to do with actual orders. When I say it's an order block, what I'm saying to you is the algorithm refers back to this as an order block. It has nothing to do with mitigating. Order blocks don't get mitigated, okay? The market, when it trades back to this level here, you want to take the opening price, extend that in time. I hope you guys liked it. I'm having fun today. Hope you're learning something. Give me a tweet and tell me if you're having fun. All right, so this order block, okay, this run lower and then shift in market structure, where does that occur? Right there. That candle right there. It's a shift in market structure. What took place? The sell stops or sell side liquidity resting below here has been purged. So if we take this level here, put it right there. I told you when we were here to put that level, the blue shaded area on your hourly chart, and to note that. If it was up here and I tell you down here, where's my bias? Down. How far? To that fair value gap. Once it hits it, what do? You log it. Does it offer 5 handles? If it does, you annotate your chart and you say, this is what I seen, and you put in annotations like you observed it with foresight before the fact. And by doing that and putting it in your chart, technically, if you're going to be highly critical, you're technically lying to yourself in your annotations because you're giving yourself positive self-talk like you saw it coming. When you look at your charts on the weekend and you refer to your annotations, what's actually happening is it's very aesthetically pleasing to see positive self-talk in your charts, but it's also subconsciously reinforcing the positives of what it is you're supposed to be retaining in price action. And you're teaching yourself subconsciously to remember these things as what? Worthwhile endeavors. Not, I'm afraid that I'm going to get it wrong. Do you see what just took place there? There's a subtle shift. That paradigm shift is required for people to filter out negativity. Never invite it in your annotations or your logging in your journals, or even in your social media posts. Never post regret. Not because I don't want students to see that they're failing. No, that's not what I said. You can say, I lost on this trade. I did this and it didn't pan out. Okay, great. That's responsible. That's also sharing the community. Hey, look, I tried it. It didn't work and I'm moving on. Not, I blew it today. I'm so stupid. I'm going to quit. I can never figure this out. This is so dumb. I'm dumb. You know, do you see the difference between that and the former? It's too toxic. People reading that, I guarantee you, they're thinking, man, this person's a wreck. And you are if you're doing that. Because what you're trying to do is you want to be coddled. I don't coddle. I'm going to tell you if you made a mistake, I'm going to say, okay, log it, learn from it, and don't repeat it. It may sound insensitive. Maybe that's not the response you're looking for, but the response you're looking for, the sugar coated, candy coated ICT mentorship guy, that doesn't work. Okay, that does not work. Candy coated mentorships and mentors are never going to give you the meat and potatoes that you want on your bones as a trader. There's no way to say it other than that. You want the real truth? The real truth is this is hard. You're going to earn it. It's going to feel uncomfortable sometimes, and that's normal. You press into that. And every time you do, and you get more insight and more confidence, it's harder for you to be defeated by yourself, your old self. That old self has to die. You got to put it down. And you're going to renew yourself into a new mindset, replacing positive. Everything in your life will become you're seeking the positive. And you're going to take a different approach in everything you do because of what you do with your money in this trading endeavor. It's going to transform you into something totally different. And you won't even recognize yourself at the end of the year. You won't recognize you. And that's a good thing. Don't be fearful of it. But this down close, these two down close candles, that's an order block. The algorithm, what's doing is once this shift in market structure occurs here, like it does right there on that candle, right at that moment there, the algorithm says, okay, I need to reprice higher. It's going to start booking price higher. It doesn't matter, folks. Jim the Trader on Instagram, okay? It doesn't matter what he says. His cousin used to be a broker. His guy's nephew's son's sister's a market maker at UBC or whatever, whatever the hell that you're going to try to tell you. I don't care. All of the things I'm going to show you real time this year is going to fly in the face of everything else out there. And I want you to figure out if it's not what I'm telling you what it is, and proving it over and over again, then what on earth is it? Because it's not retail. It's nothing in those books. But you have to see it. You have to handle it. And once you see it and you handle it, you're like, oh no, this is something totally different. And that's what happens when people come into this content. It's infectious. It's sticky. You can't get it off your hands. You want more of it though. It's like cotton candy. This return to this order block, the market will want to do that. Once it does that, it accumulates buying opportunities. Let me say it better. It provides smart money to accumulate long positions when it returns to this. The algorithm is not waiting for smart traders to buy, and their buying is not propelling price higher. It's going down there based on time. It goes down to it here, pulls away from it, and goes down to it one more time. It's spending time allowing individuals that are privy to what I'm teaching you, what I'm showing you. There are people that are waiting for this opportunity. That is what they're paid to do. They are bank traders. They are not JP Morgan traders. They're not Goldman Sachs traders. They're at the bank. Oh, but they won't. Not for this discussion. I don't care if you believe it. I'm not here to try to twist your arm in regards to that. But this run here, did it take out that high? On this run here, away from the order block, when it has a shift in market structure on that candle right there, when it moved up, did it take out that high? No. What did it leave there? Buy side. I was talking to you earlier, and you'll hear it in the recording. You'll see it in the recording. I mentioned that there's buy side here. Be mindful of that. Okay, and I went back to my conversation. The market drops back down into the order block. The algorithm offers the opportunity for traders that are looking for it to get in. Reprices higher, rejection block, retraces back down to the order block. Once more, what's it doing? It's allowing smart money to accumulate inside the order block. What else is it doing? For supply and demand, folks, fasten your seatbelts. We're cutting through some candles. Oh no, we're going back into that area of Inefficiency. It was inefficient in what? Sell side. It went up. It offered it here. Okay. Is this balanced? This range here, is this range here balanced at that point? No. It's only balanced when it comes to it and leaves it. Now it's a balanced price range. This is an entirely different endeavor of running out liquidity that's formed here. It does not cancel this out. If you've gone through my core content, I teach you the PDRA matrix, and there is a 20, 40, and 60-day look back. And there's a 20 and 40, 60-day cast forward. The algorithm refers to things in that scope. And I could obviously turn this into a whole all-nighter here and teach and teach and teach. And it's just going to give you more things, especially if you're new. If this is the first time you watch me, it's going to seem like it's too complicated. And it would be viewed as complicated for anyone that hasn't really spent any time with me. But for the folks that's been here for a while, this is already starting to make a lot of sense to you, and your gears are turning like, oh my goodness, I see it, I see it. Right. It's going to keep repeating too, every week, every day, and it won't stop. I'm not changing anything. Okay? It will not stop working. It will not. Trust me. The markets will cease to exist before this stops working. Period. If I believed by making it public it would change or stop it, you never would have heard of me. So it trades down into the old fair value gap. What is it offering? Sell side again here and the order block. So how many factors do you have here leading to the likelihood of these relative equal highs, much like they were over here? What's above here? The same thing we have here from a narrative. We have buy side. What did price do from here? Drop down to what? To that low. Why did it do that? It took out sell side. Why would it be advantageous for the algorithm to reprice all the way down there? You're trying to tell me that only short sellers came in here. Nobody bought. And that's what drove price down exactly to the fair value gap that I outlined beforehand. So every trader out there knew the fair value gap. You all just discovered it this year. My mentorships students learned about it in 2016. I've been using it for 26 years. So you're wrestling with trying to find a rhyme and a reason as to why I can do this and why my students are able to do this, and you can find another similarity to something else and lean on retail logic as to why the market's book. Oh, it's just auction theory. No, it ain't. Oh, no, it's not. It's not. Anybody that sits down and does the work of going through what I'm teaching, that's dismissed immediately. The volume of how many contracts are traded is irrelevant. When they want the market to go to a price level, it's going to that price level regardless. Regardless of how many buyers and sellers there are. Why would it be advantageous for this level to be taken out? Because it's allowing traders that would be looking for higher prices, keying off of that discount array, which is the fair value gap on the hourly chart, that blue shaded area down here that I tweeted beforehand, before it even went there. Look at the turning point of that. Is that not beautiful? When I was a younger man, when I first started to learn how to trade, I never imagined that there would be this level of precision available, that anybody could see it before it happens. And you all get to walk with me every day, every week, and I'm showcasing it. No deleted tweets. It's all there. I'm bringing the receipts all year long. All you have to do is start paying more attention to it. And what does it mean to you? What is it communicating to you? Because there's lots of trades here based on what I just shown. There's many trades that you can take. But this movement here was the catalyst that sent us up into the buy-side liquidity that I talked about in this live stream. That's where it's going to go next. What does that mean? It's not going below that low. Your focus was placed up here. Did it not do it? It did. Is it a big deal? No. But to a new student, for a new viewer, a casual viewer, well, that was kind of lucky. We get lucky a lot around here. Like it's a reoccurring phenomenon around here. I don't personally believe in luck, but it is what it is. But then we run from the order block up to and through that buy side liquidity. Runs above it, comes back down, works inside this range here. What's this down close candle? What's this right here? It's the same thing this is. It's an order block. It has absolutely nothing to do with how many contracts are bought or sold. It has nothing to do how many orders are resting on the depth of market, the DOM, using ladders and stuff like that, market profile, point of control, all those things. I am not a believer in that. If you make money and you use that stuff and you attribute your profits to that, then well done. That's what you believe. That's what you subscribe to. And I'm not going to have any ability to defer your attention to anything else if that's what you subscribe to. And you shouldn't even pay me any mind. If you're making money, it's irrelevant what I say. No matter what it is that you use, if you're making money, don't tinker with it. But don't say that that's what's making the market go higher and low, because then we will argue. But this is an order block. Okay, it's a down close candle prior to the change in the state of delivery, which is occurring right at that opening price. Extend it out in time. As soon as that price is touched and crossed to the upside, that is equivalent to a market structure shift. At that moment, this entire range here becomes sensitive to future returns to it. And I'll explain that in a minute. Man, ICT's pulling out a clinic, a price action clinic today. So down close candle, displacement to the to the upside. Watch that opening price. Why is the opening price? Well, because there's no wick. Well, why did you use the opening price down here, ICT? Didn't think I'd get back to that, did you? Why did you do it on the wick? Because whenever it's a short little stubby wick like that, I just immediately go right to the opening price. That's just because I've traded Forex, and Forex has a lot of spread issues, and that was where I adopted the rule set. There it is. But the hard and fast rule is if it's a really little small little wick, just go to the body's opening. Market trades down into it here. Look how much around the midpoint of that candle, which was mean threshold. Half of a gap or inefficiency is consequent encroachment. It's the midpoint. If we have a order block, that's not a gap. That's not a fair value gap. It's a specific range in one candle. You split that in half, that's mean threshold. Look where they're going right here with these candles. Boom, half, 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 half. And then breaks higher. What's occurring right on this candle? Let me zoom in here because I want you to really get this. When I'm watching my real-time trades pan out, and you see the recordings of it, and you see me annotating as it's going, and I'm drawing lines on it, and I'll say I want to see it run from here, and I want to do this. I'm doing all of that with 1 minute candles. So I'm looking at price, internalizing, receiving what it is I'm seeing in price delivery. Then I'm articulating a way of communicating it to you. Then I have to go to my keyboard, then I have to type it out. And then sometimes I have to correct the typos and then still maintain my focus on the chart. Now imagine all that going on with somebody that has attention deficit like I have. It's hard. It's very, very hard for me to do this, to communicate it on a 1 minute chart. There's no way to fake that. There's no way I could be managing another chart somewhere else. I have, well, right now I'm staring at 8 monitors in front of me, but I'm holding a laptop. This laptop is away from my trade desk, but I'm in the room with them. Those screens are not even on. And when I'm doing everything through the recording with Camtasia, I'm recording and I only record with a laptop on a ISP that's only synced to this one. My trading computers are using a different ISP. I'm never going to record off of those. You're never going to see my TradeStation charts. You're never going to see those things. You're not. So don't ask for it. I'm not making you that close of a friend to me. Okay, it's not to be rude or anything, but you don't need to see those things. Everything I'm teaching is communicated through TradingView. And I'm using a laptop because if I do get hacked, which I've had multiple instances of since 2006, they're not getting anything here. There's no credit cards. There's no nothing personal. Nothing. It's just the ISP connected to YouTube and TradingView. That's it. That's it. So I had to say that. I'm sorry, but when we leave, when we leave this consolidation inside this order block, okay, it drops down into it here. Mean threshold is half of the order block, so half of this range. And I'll show you that. This is what you want to do with your fair value gaps and what you think is an order block. So 40.27 even. Okay, 40.27 even. In my mind, I'm watching on a bullish order block, I'm watching the high to the midpoint. I want to see it show a willingness to support price, preferably hit it and quit it and run the other direction real quick. That's what I'm really looking for. But if it starts doing this, and as long as it's respecting that midpoint down here, I'm okay with it. I'm more specifically going to be watching if it starts to consolidate. I'm going to go in with like 6 contracts. I'm doing my typical go in, I buy 6 contracts, and I'm going to try to parlay it up and build a bigger position. What would I do? In this instance, using the order block, I'm going in right there at that price. I'd be going long on the first return to it there. So I would go long 6 contracts there. As it's digging down, I'm going to watch. Does it want to go to the mean threshold? Mean threshold is half of an order block, or half of a breaker, or half of a mitigation block. And go back through my core content and you'll see all that stuff. It's on the YouTube channel. Then I would buy 3 right here on this candle as it hits the mean threshold. So now would be long 9 contracts. If it runs like it does here, and then one more time pumps into it one more time, then I'll do my one last contract, and I'd be long net 10 contracts. 6, 3, 1. Hoping that I can get the little wick through, the midpoint, trusting that it isn't going to go to the other side. See, you're thinking, how do you know ICT? Didn't think I was going to know that, did you? How can you trust it, ICT? Experience, knowing that it's likely to do what I'm explaining here, and also being comfortable with being wrong. Because I can be wrong and be profitable. I can be right and be not as profitable as I should have been. There's a gray area where experience dictates the outcome. And I don't make any sugar-coated claims to make you not understand. It's going to take you work to study this. But over time, you'll see it, and time does its work. But when we see this range here, the midpoint of the order block, once it leaves it, okay, once it leaves that, what's this candle right here? This is a propulsion block. It's an order block within this order block. So it's a nested level. I love this formation. I love it. Let me show you why I love it. What's the opening price? What's the opening price on that candle right there? You should see it right up here. 4029.25. Okay, 4,029 and a quarter. That price to its high, right in here, that is one of the most sensitive bullish order blocks. Responsive, quick, sudden, like it's like it, like you want to see a dynamic movement. It's going to really do it on this. Like, show me the order blocks that work. Well, here's that lesson. Here's that lesson, folks. You're probably listening to me driving in your car, or you're working your forklift at work, scooping out ice cream at Bob Evans, or not, maybe not Bob Evans. What's the ice cream place now? I got to figure this out now. I can't go past it now. Baskin Robbins. That's what I was thinking of. Wherever you're at, you're working. You wished you probably would have watched this with with the notepad. But go back and just remember that we're talking about the propulsion block. This opening price to its high, that is the absolute most sensitive area in order block theory. What do you see? What's the opening price of this candle? 4,029 and a quarter. It goes through it. It leaves it on this candle. Does it not? Yes. The next candle we open here, what's the low of that candle? this price right here. What's the low? 4029.25. Wait a minute. Wait a minute. Deja vu. Something different here. No, it's exactly the same. The opening price, 4029.25. Now I know, pick your jaw up, okay? Pick your jaw up. That again is exactly what I taught you in those core content lessons. Those videos were produced in 2016. It's logic that I coined in 1996. It's never been in any books. It's never been taught until I released it. You cannot improve upon perfect. You can't improve upon it. It doesn't fluctuate. It doesn't fall short of it. It goes right to the tick. And it does what? It delivers exactly the logic I teach you for a propulsion block. The run in price here, you have several things you can look at. You have the buy side relative equal highs here. Take this off. I'm having too much fun now. You guys asked for these live streams. Now you're going to be killed by them. Don't get on ICT. Don't get on I need to have a marriage. So we have buy side here. And also, what is the highest? Look in here. Look in this area here. What is the highest closing price? What's the highest closing price? Right there. I'm going to walk through the PD array matrix with you, okay? There. And what else do you have? What's the highest high? Right there. So this high, what have I taught you about that? Wicks are gaps. What? Wicks are gaps. Midpoint of that gap is consequent encroachment. It's 4,036 even. What is the closing price on that candle? 4,036 even. Yes, there's a small little wick. I don't care about that. I'm caring more specifically about the bodies, because the bodies are going to tell you the narrative. The wicks are where the damage is done. The bodies are what I'm looking for. That's telling me the storyline. What's the opening price of the next candle? 4,036 even. Can you improve upon that? No. What happens after that? Recedes and goes lower. Does it offer from this point here, buying into the propulsion block, from here to the first rejection block, right here? That's the first of your premium arrays. Does it offer 5 handles there? Yes. Why do you think I've been telling you 5 handles? 5 handles is all over the place intraday. It's all over the place. There's so many opportunities to get that. It's very forgiving for folks that miss a move. You can find it again if you're using a 1-minute chart. Oh, ICT, I wish I could just be able to afford to pay my utility bills a month. Well, start mining this, and you might be able to do that. I can't promise it, but you might be able to do that. Let's go back to the propulsion block. Right in here. What does it leave? What is that? Let me do it this way so you can see it. It's a fair value gap, isn't it? How do you know it's going to stay open? The propulsion block. This shouldn't stay open. It should stay, I'm sorry, it should stay open. It should not fill in. This would act as what? A breakaway gap. So if this is breaking away, I'm going to expect what? Price delivery to be more bullish candles, very little retracement, and maybe 1 or 2 down close candles. Everything else be what? Bullish delivery. Buy side being offered. How many down close candles do you have from the propulsion block to the consequent encroachment of the wick. You have one down closed candle. Why is that important? You need to know the difference between signatures that are going to be favorable for you. If you start seeing a lot of consolidation and down closed candles forming and booking in a price run that you're in, chances are you're probably going to get a retracement and come back on your stop loss, or it's not going to go in your favor anyway. So I'm looking at how does price continuously deliver. Is it giving me bullish candles? Is it staying bullish each time? With the exception of this candle here, every candle was bullish. And I'm not worrying about all the little whipsaws back and forth because I'm not going to ram my stop loss up there theoretically because I want to see it do what? I wouldn't even roll my stop up until this short-term high was taken out because above that is what? A very small pool of buy-side liquidity. Buy stops. Anyone that's short, they would have trailed it from here to here. And then we move back into consolidation. And we're entering what time of day? Noon. That's lunch. I teach that you, most of the time, you're going to be squaring your position before noon. I'm not saying that I don't trade in lunch. I do. I have done it. But as a developing student, you don't want to be doing that because you don't know the characteristics that are part of that. All right, we're in the noon lunch hour. And at the time, I've been going for 2 hours. More than 2 hours, like 2.5 hours. It doesn't feel like it. I mean, some of you probably think, man, this is a lifetime. When are you going to close this thing? I'm afraid I'm going to miss something, but it's getting on my nerves. It doesn't feel like a long time for me. It feels like I've been here for like 20 minutes. So if we were to look at the rest of the day, okay, we've moved in a range that it looks as if we've already taken sell side here with this drop. This is a little too clean. I'm not trading the rest of the day, okay? But I would watch this area here. If it doesn't run for it, going into the 2 o'clock hour and it leaves this low intact, if this low stays intact, if it doesn't breach that low, I would look for the last hour trading to try to attack this. That's how I would look at it. Now, that's just forecasting. That's not trading. That's not saying it's absolutely going to pan out that way. That's how I would plan. Like I would go get something to eat and come back to my charts at 1:30 and see, does everything I just said exist still in the chart? If this low stays intact and we haven't gone below it, and this stays like it is, nothing piercing it, then I would expect the final hour trading to reach for 40.38. And I would plan my afternoon like that. And if I come back and it has done that, then I would do nothing for the last part of the day. So that's how I plan my trades. That's how I plan my sessions. I think about the logic and I just mapped out why I just said what I said. And if it's anything other than that, I'm not interested. It can do something. It could completely collapse and go down below 4,000 from where we are right now. That's not my trade. I'm not in that. I'm not participating in that. I'm not claiming to be in every single swing. I am claiming that you can find very specific surgical strikes with precision, and it doesn't need to have any indicator, nothing that's going to be, in addition to. Anything that I apply to my chart is just lipstick to accentuate, dial in your attention to a very specific element of price. I don't have it on my chart. It's an adjustment for me to have these things while I'm watching price. I annotate them and then I turn my attention to my other charts. Because if I look at things I draw on the chart, it's a distraction to me. I'm very obsessive and it's very difficult. And you'll probably hear me vocalize that, in certain times when I'm doing the live sessions because it will be something that I wish I didn't have on the chart, but you're going to find it helpful to you because your frame of reference needs to be anchored on some limitation in price action, not like everything that's been explained here doesn't even factor in all this over here. This is already done. This fractal's done. I've already outlined it and you see when it's done. I've given you my expectation for the afternoon. This low, we ran out during the lunch hour. It only took it 2 minutes to get into lunch hour to do it. So this drop down, I like that. I like the fact that we have relatively equal highs. I'm not trying to call a top in the marketplace, so I'm not going to arm wrestle that logic. What retail tries to do, they try to pick tops and try to pick bottoms. I don't do that. I look for where the obvious liquidity is, and the low here, they ripped through that in this low here. So we ran through that. This is not smooth anymore. It's jagged. Where's their smooth levels? It's here. And if it was to drop through this low, I don't do anything. I just take the rest of the day off. Now think about that for a second. Doesn't that sound like someone that has it put together? They're not just jumping around and reacting to price. They can plan their day. They can plan how they're going to engage the marketplace. They're not chasing something. They're not fearful of missing a move. I've outlined if it does any of these things, then I'm not interested. Do you have that in your system right now? Chances are, if you're new, you don't. Those are things that experience teaches you. Consistently profitable traders, I'm going to say this in closing, they have processes to get into a trade. That's without saying, obviously. They also have processes that keep them out of the marketplace for various reasons. It may be an economic report that's due that's going to invite a lot of volatility, or it may be a expectation that the market does in fact do nothing, and it's not imperative for them to engage right now, and they'll wait for a later time for the market to get more animated, and then they'll participate then. They're not, and I'm not, and my students that have adopted this mindset, we're not worrying about missing a move. And if a move was to manifest itself and rip and tear off and do something phenomenal, and we aren't a part of it, we're not grieving over that, because we know that we can find repeating phenomena in price action that are rooted in statistical probabilities that you can go back and see many times of that very thing occurring. But it's not the same thing as saying, like I've taught, and there's a joker out there on Twitter right now trying to make a name for himself because he's crunched some numbers. In my lectures, I teach that when it's in a bearish model, okay, it's in a sell model, the high of the week tends to form 70% of the time on Tuesday. If you take every week indiscriminately and look for, does it form the high on Tuesday between 2 o'clock and 4 o'clock in the morning, you're going to get data that doesn't support that. You don't even define what a sell model is. I do. So having that mindset, I'm not going out there every day thinking the high of the week is going to be on Tuesday or the low of the week is going to be on Tuesday between 2 o'clock and 4 o'clock in the morning. There has to be other factors that filter that. And that's what happens when people come into my content and they cherry pick things that they hear me say and they take it completely out of context. But then when you sit down with me and I'm outlining things real time before it happens, they get quiet. They want to talk about things that aren't true, and they're going to try to distract you. And you need to think about what it is that you're seeing, what you're witnessing, what you're seeing other people profit with real money. Is there more things here inviting you to dig deeper for free? Or is there warning signs saying, I better not touch this? This ICT content is a plague. We need to teach people to stay away from it. You're going to hear a whole lot more of that as the year goes on because you're not supposed to learn this. Right now, it's just jokers and people that are jealous. But I'm telling you, you watch and see how it just starts to manifest. There's going to be a lot more spotlight placed on the things that I'm teaching here. And there's going to be a whole new level of campaign to smear it. That's okay. You ain't changing anything. You ain't stopping anything because it's already out of the bag. It will repeat every week, every day, and it won't stop. I do hope you had fun with me today. I hope you had some learning. Hopefully you picked up some things and you've adopted some new approaches and techniques and thought processes. I just want to scan through real quick before I close. NASDAQ is ugly. Look at this. Look at this. You should be seeing a Nasdaq. That price action on the right hand side. That right there is a day that says, "Don't touch me." Now you might see that and think something else, but I'm saying that right there tells me, "Don't touch me." And because I say don't touch the NASDAQ, what's closely correlated to NASDAQ? ES. So if it's a no touch on NASDAQ, then it's a no touch on what? ES. They have to confirm one another. If I don't see a sustained move in all three of the averages, and here's the Dow, if I don't see a justification for them to move in agreement, then that gives me the market breadth, the trust that we have a sustainable price move underway. If one of them acts like a sick sister, this one here is like a hobbling, bum leg. It's not doing all that much in terms of symmetry. It's just all over the place. Looks like a heart attack. That's your warning sign that you're probably trading with low probability conditions. So going back to ES, while I do believe that those highs could be taken out, because of what I just shown you in NASDAQ, I'm probably going to be incorrect. So I've subscribed to something publicly, but I'm also communicating the reasons why I personally will not be going back in to take a trade because of what we're seeing in NASDAQ. Now, doesn't that disarm you? It gives you a reason to say, okay, I'm not going to be doing something and I'm okay with not doing it. Not, I don't know what I'm doing, but I feel like I'm missing something. Big difference, isn't it? So that type of feeling, that comfort comes from someone that's been doing it for a while. And traders that have been subscribing to me on my Twitter feed, they have been benefiting from that because they've seen a lot of, well, things that would otherwise be distracting, not really providing any clarity as to what they would expect, as a trader, what they would be doing as a trader and how to think as a trader and well, how to conduct themselves and think. And these are lessons you have to walk with someone doing it. You can't just read it in a book. It doesn't communicate well. You have to walk with that person doing it live, seeing what they would think about at this moment, at this juncture. Does the things that you are hoping to see in price action, does it still ring true now? And if it doesn't, why doesn't it? And if it doesn't, communicate why that's useful and how we can take that insight and move forward with it so that way we won't hurt ourselves as students. That's my motivation. That's what I'm trying to do because I've already taught you how to trade. I'm not sure what just happened, but it's connected and reconnected, hopefully. I promise you, you will not regret having learned this. You'll do amazing things with this information in your personal life. Doesn't mean you're getting rich. It just means that you're going to do amazing things and your direction of your life is going to change. You'll be more organized, the way you take on risk in every aspect of your life. And to me, that's a success. So that's it for this one. Hopefully you found it insightful. Hopefully you found it encouraging. And until next time, be safe.